All right. Anything further? Should we go to Brett? I think Telesat. Many questions on satellite, global satellite providers. Been a sleepy industry for years, and now suddenly it's back, baby. Apparently, so we'll find out what all the interest is surrounding TSAT or Telesat on the TSX and NASDAQ.
Yeah, and like just start that off. Just I think that really investor hype, I guess, around satellite and space in general really was pushed up by, I guess, Candace's favorite person right now, Elon Musk, just with SpaceX. I think that's really driven the interest behind it. But then, interesting enough, Telesat actually has a relationship with MDA, the other big Canadian space company, which we've had questions about before. So it's actually quite interesting how these satellite companies, quite a few of them have relationships with each other, even though some of them do compete against each other. This isn't the case here, but it's an interesting industry right now. It's definitely changing into the LEO space from what was traditionally the geosynchronous, which is, I think, around 35 times farther away from Earth than the LEOs. So the constellation satellites, and I'll really get into that, why Telesat's actually moving in that direction. So we'll get into that in a minute. But Telesat Corp, symbol TSAT, TSAT on both the TSX and the NASDAQ, is a global satellite operator providing communication services since the 1960s. It actually started as a Canadian Crown corporation, but is now a public company, and it IPO'd in 2021. The company currently has two operating segments. It's geosynchronous Earth orbit business, which is that GEO or GSO. Satellites, which I was mentioning before, 35 times or so farther away from their LEOs, and broadcast and enterprise is their other segment. The big interest, though, in the company, like I was saying before, is their satellite constellation, their low Earth orbit satellite constellation, which they are currently developing, their Telesat Lightspeed. The first Lightspeed satellites are expected to launch in mid-2026, and global service is expected to begin in late 2027. So not existing at this time, but that's really where the valuation, the interest in the company as a whole is coming from. The stock is currently trading at $23.60 and a $1.2 billion market cap. The stock has had great performance over the past year, up 124%, despite the recent pullback in the stock. But like everything right now, it's a volatile market. The price I'm probably saying now has no meaning to when you're listening to this a day from now. Shifting to the financials for 2024, revenue came in at $571 million, down from $704 million. That's due to lower direct-to-home revenue and foreign exchange being a big factor here. Adjusted EBITDA, which removes the impact of that foreign exchange, as well as interest, which they do have a lot of debt, which I'll get into in it. The company had major impacts due to U.S.-denominated debt being repurchased as well. So adjusted EBITDA removes those factors, but that only fell 28% to $384 million from $534 million at a margin of 67% compared to 76% in the prior year. GAAP EPS, it fell actually to negative, and that's due to those factors above being the major factors for the difference between adjusted EBITDA and EPS. It fell to $6.29 a share, or a negative $6.29 a share, from an income of $11.29 a share, and they actually had some gains in the last year. Very messy GAAP financials. But the financial decline is expected. It was expected and is expected to continue into 2025 on a top and bottom line basis. Management is guiding revenue between $405 to $425 million, adjusted EBIT between $170 and $109 million, which is impacted by higher LEO expenses of $110 to $120 million. The company expects CapEx of $900 to $1.1 billion. So that upper end is near even their market cap, and this is what I mean. It's really up for that build out of Telesat Lightspeed, and it's a very expensive project. Clearly, Telesat isn't a company you are buying for this year, this past year, or the next year. It's a company you're really looking to buy 3 years from now, where the value is coming from with Lightspeed. So let's take a look at the company's projected long-term outlook. This is the company's numbers, not mine. As I said before, Lightspeed service isn't expected to begin until late 2027. So we're still over 2 years out before any really income coming back to them from all this massive capital expenditure. So starting in 2028 is where they start their long-term outlook. Revenue is expected to be at $600 million, with growth to $3.2 billion by 2030. 2032. That's a CAGR of 52% over this period. So they're expecting very high growth once the Lightspeed constellation gets up and going. EBITDA, or adjusted EBITDA, is expected to be at 400 million in 2028, growing to 2.7 billion in 2032, a CAGR of 61%. Obviously, that will have great margins, as the main costs are being those initial capital expenditures. The company does also expect to start disclosing Lightspeed backlog in Q1 2025, with external analysts, not ours, currently expecting approximately 1 billion in backlog for that initial or backlog in revenue for Lightspeed, so still a couple years out. So how do they get there? They have to fund it somehow. To fund the initial 156 satellites, which is a cost of US dollars 2.8 billion, operational cost of 700 million, and as well as they have a budgeted for a contingency of 300 million for a total US dollar value of 3.8 billion. To fund this, they have already received and will receive some continued government funding. They have total government funding from the government of Canada as well as the government of Quebec for 2.54 billion Canadian or 1.9 billion US, with the remainder being funded by the company's equity of 1.6 billion. Plus, they have another 300 million in vendor financing. Further, the company is expected to use the internal cash flows once Lightspeed is up and running of 800 million for an additional 42 satellites, which are expected to be in service by the end of 2030, putting that total project capex for the full satellite constellation at $4.6 billion US. And remember, that is 4 times the Canadian dollar market cap. So massive amounts of capex going into this project. So looking at the balance sheet, the company has cash of 552 million, long-term debt of 3.1 billion at this time, resulting in a net debt position of 2.5 million. The company did receive its first funding from the Canadian and Quebec government in January, so that's not appearing on this balance sheet. And the company is looking to continue to restructure its debt. They repurchased some US denominated debt last year. So the cash and debt position will shift, and it will overall shift higher during these next couple of years. The capex spending is massive. Like I said before, their projected capex is 900 million to 1.1 billion dollars just in 2025. So massive capex that's going to mainly be appearing as a debt position. But even if we look at the trailing net debt to EBITDA, the 6.6 times is already very high, but their earnings are quite low relative to what they expect in the future. So if things go awry, if there's a big delay for whatever reason, if something significant happens, major setback, it pushes out 1 or 2 years, that can significantly impact the company because they do have this large, by absolute value, debt load, even if you ignore the relative leverage ratio at this time. So if significant setbacks can actually impact the company's viability, at least on your equity position. So moving to some operational highlights, as it is a very forward-looking company. The company, like I mentioned before, they partner with MDA Space, another public company, as its prime satellite contractor, and they announced in December that the program has successfully completed the spacecraft preliminary design review, which validates the performance capabilities of the satellites, as well as the company has service contracts or expected agreements to be finalized this year with Viasat, Space Norway, Orange Telecom, and ADM called Telecom for their Lightspeed constellation. So if you start to see those, that adds a bit more validity to the company's long-term forecast when you have these contracts in place, because then you actually can put a higher degree of certainty on them actually hitting those at least revenue targets, assuming things go to plan. But concluding, Telesat is very much wait and see from a fundamental point of view. They have funding for a very capital-intensive project, but now we need to see if they can really build the project on time, on schedule, in budget. And then the next stage after that would be, is the growth profile, is the actual cost and revenue and cost profile aligning with what they say? I wouldn't say they're not making up. They're not. It's in line with their historic revenue and EBITDA margins. So it's not outlandish or anything like we do sometimes see with some of these companies that have no past record, where they just pull numbers out of their ass. But that's not really what I see here. But it's just whether or not they can actually do it on time, do it within budget, or do they need to go deeper into debt? The company does just have loads of debt, but it will be very free cash, and it will be very free cash flow negative until 2028. But then it'll move into very big cash flow positive past that if they can actually hit their targets. And that's really what I would be monitoring for this time, is if they can progress to that stage. But right now, we will just monitor for light speed progression more than anything.
Yeah, I mean, I've seen several of these examples of companies that they really have these super levered balance sheets. They have these grandiose growth strategies that are going to be heavily reliant on issuing shares and debt. And it's like, it's a great story, but that's really all it is at that point in time, is a story. You know, at such time as it turns into more reality, then okay. But 6.6 times, that's already a huge leverage ratio, very, very highly levered. You know, if this were like a cash rich business, it was like, oh, we have this cash, plus we'll take on some debt. Great. But when you're already sitting at a huge, and I recognize that they are expecting a expansion in that EBITDA, which would improve the multiple, but that hasn't happened yet. So, you know, wait and see, as you said.
Exactly.
Yeah, I mean,
it's one of those.
Sorry.
Go ahead.
Yeah.
No, go ahead.
Well, there's just significant volatility in this stock, period. If you look back just to the start of 2022, I mean, it was at $49, right near the start of January. And then, you dropped right down to, by May, 15, and then it had spiked up again to 21. Then it went down to 9. And then you go to September 2023, 12, then jumped to almost $30, then back right down to $10. Then it spiked up, just since the start of this year from the range of 18. It went as high as, about 36. And now it's, back down to 20. Investors, like I'm surprised they're looking that far ahead on this. Half the time they can't even look a quarter of ahead when we deal with tons of investors. So you're looking multiple years ahead until they have real significant cash flow. You're going to have declining results, I believe, in the near term, are you not? Like over the next several years.
Yeah.
So like investors' attention spans seem very limited. We wouldn't be surprised, though there is a future outlook that is reasonable and calls for growth at their historic margins. There's a hell of a lot that can happen on the way to getting there. And I think there's still significant risk. Maybe there's a buying opportunity ahead of that. But with the historic volatility, even just in the last 3 years that I'm talking about there, in this market, I wouldn't be surprised to see a significant pullback. I mean, again, that's just guessing because we can't price it on its current fundamentals. You have to be pricing 3 to 5 years out.
And that's inherently the difficulty with a company like this. So the values we were quoting at late or early 22, that was just right after the IPO too.
Yeah.
And then it got cut into a fifth of what it was really right after that the following year. And it's just because it is speculative. And that's what I really want to get at, is how speculative it is. Even though they do have guidance, even though they do have an outlook, it's still very speculative, especially for the next 3 years.
Yeah, and when we do have existing current fundamentals and growth guidance going forward, you tend to not have this volatility that you're seeing in the share price because you have something to fall back on. Right now, the cash flow, the real earnings, the reason to be in this story doesn't happen for years into the future. So that is not surprising to me to see a stock going like this. And it's not doing this, it's doing this. It's going sideways through this. Having current fundamentals allays some of the risk and you can value it. I don't think anybody can value this. Well, certainly based on current fundamentals. We like to have a mix of current and future. This has future, not really the current fundamentals that would justify buying it right now. So you're certainly adding a layer of risk that's not there in many of the companies that we look at.
It's really that
Hopefully
big
that makes sense.
Jump in debt load and capital size. It's just the future projects, even though they do have some current fundamentals, it's just on a whole different scale looking forward, which is
yes, for sure.
the difference there.